Okay, we are broadcasting and 3 people are here today. Appreciate you all coming. Haley, how far did you have to drive?
I live
Where?
in Princeton.
Do you have any slick roads?
Yeah, my neighborhood usually is pretty bad until like the afternoon because they don't get to scraping it until after.
The last time they put us on late schedule,
I thought we
it was not bad out at all. And this morning, of course, I had an hour drive and 5 or 6 miles into Tazewell County, it's really slick, both sides. And everything was moving 30 to 40 miles an hour. But anyway, we're here. Somebody falls on those steps out there, called to have a lawsuit. I think somebody called and asked for salt. And I'm sure there'll be some parents calling the administration complaining because all classes in some of the other schools don't have live streaming like we do. So I think all of them are gearing up for it, but they don't have it. So we're here and we're broadcasting. So there's probably a few problems in chapter 11. We'll wrap those up Thursday, but right now we're going to go into chapter 12 as hot and heavy as we can. So for at least about an hour this morning, Haley's got to leave early anyway, right, Haley?
Yeah.
Well, 15 minutes to do it?
What?
What, about 15 minutes?
And I'll probably have to leave at like 10:15.
Oh, okay. But anyhow, I think it's ridiculous. We should have been on a late schedule, but that's okay. Proprietorship. Well, no, we know that. Characteristic proprietorship. Don't know what's wrong with my TV up here. Power button usually won't work it. See if I can get a TV booted up here. Okay, this one should boot up. And this one is booted up, okay.
Do you have another pencil? Mine has a lead.
I could loan you a pencil, hey.
I thought I had two.
Don't know why that one's not showing up. I need this one to come up. I don't know what's wrong with it. There it is, finally. Okay, characteristics in a proprietorship. No limitation on legal liability. That means you can be sued. We mentioned that before. They can take your personal assets, non-taxable, for federal tax purposes. The proprietor is not taxed, but he has to pay taxes. He does quarterly taxes, pays it on his 1040. Limited life. If the owner dies, retires, it's gone. And limited ability to raise capital. Again, you've seen these characteristics in other textbooks. A partnership is 2 or more people. Now, a partnership can incorporate. A proprietorship can incorporate. All right. Co-owner of property, share gains and losses. One partner could make a debt in the other partner's name. That's dangerous. That's when I said you need to be bonded. participates in the income, you should have a good agreement. We looked at some ways, but we'll look at them again. Then an LLC, it provides limited liability to its owners, but treated as a partnership. Characteristics of an LLC requires an agreement among owners, just like partners. It has limited legal liability. That's better than a partnership. Not taxable. The partners are taxable. You can have unlimited life because it can continue, and you have a few more partners to raise capital. And here's your organizational form again. All of these are non-taxable. You are not an employee of a proprietorship. You're not an employee of a partnership. But if you incorporate, you can be an employee. Give yourself a paycheck, take out the deductions, but you got to match that. Your corporation has to match it. Now, if you're incorporated, you pay workman's comp, and if you pay state and federal unemployment tax, you can lay yourself off and draw unemployment. All right. Now, an attorney would charge you $1,500 to incorporate. CPA will charge you $1,000, but you can do it for $80. All you got to do is get on the State Corporation Commission of West Virginia and ask for the incorporation papers. Download them, whatever. Anybody can fill them out, and you can incorporate yourself. I mean, you know, you're college students. You don't need a CPA or a lawyer to incorporate. It's the only chapter we have on partnerships. Forming a partnership, I would suggest everybody invest cash. And I told you that the appraised value of everything should go on the new books, not the book value of the old proprietorship. That is, the two proprietorship, Joseph and Earl, are going in to form a partnership. Now, cash is $7,200. These other amounts might be appraised. Accounts payable probably is exact. But I would not take that person's accounts receivable at 16.3 and his allowance of 1,500. I'd have to assess those. But journal entries are the same, basically. You debit all your assets, credit your contra account, which is allowance, credit your accounts payable, and credit Joseph Stevens. But on the accounts receivable, you might go ahead and deduct the allowance and deduct it from the accounts receivable and record accounts receivable at net. Because if you're a new business, some of your customers might not pay. LLC, the entries are the same. But now look at those two entries. Look at this one for a partnership. And look at this one for an LLC. What is the difference?
Go back.
Do what?
Go back.
I go back. Here's the partnership. And here's the LLC. What's the difference? All right, look at the capital. You credit capital. Here you credit member equity. That's the only difference. Here, Reese contributed equipment, inventory, cash. Equipment had a book value of 23, but a market value of 29. So what do you put on your books? 23 or 29? Look at it. What do you put on your books? The market value or the book value? Jonathan, what? All right, book value is 23, market's 29, so it's clearly 29. All right. Now the partners assume they only had a market value of 15. That's your inventory, 15. Whoa, you paid 60 for it, only got a book value of 15. Put the 15. You gotta put the liability. His capital then is the difference, 66,000. Income or losses are divided as specified. If there's no agreement, equally. And we went over that last Thursday. All right, common methods to divide the income are services of the partner. And we talked about that. And anyway, service investment of the partner. And we're going to practice some of those. Okay, once again, if a partnership, they split profits and losses 2 to 3 to 5, what's your fractions? ABC partner, they split profits and losses 2 to 3 to 5. What's your fractions, Haley? Cole, what's your fractions? All right, 2/10, 3/10, and 5/10. Because these add up to 10, don't they? They add up to 10. And you can reduce that to 1/5, 1/2, and 3/10, whatever you want to. But one method of dividing partnership income is based on the services. All right, we did that. And if Cole worked 20 hours a week and Jonathan worked 40 hours a week, what is the ratio? Cole worked 20, Jonathan worked 40. What's the ratio? 20/40. All right. Drop the zeros, then 2 to 4. That's 2/6 and 4/6, or 1/3 and 2/3. So ratios and fractions are the same. And I hope Susan's out there watching it because she don't like ratios and fractions and decimals and percents. Assume the partnership agreement of Jennifer Stone and Crystal Mills provides for the following. Monthly salary allowances, 5 and 4, divide the difference equally. All right, I scribbled an example here last Thursday. 5 plus 4 is 9. Now, if they made 50,000, that leaves 41 to split equal. And I did that at 20,500, 20,500. I want everything to add up horizontal and vertical to $50,000. And I omitted dollar signs because, as Haley said, I can't write anyway. And when I write on these things, it can even be worse. But these all do have dollar marks. But gone is the day that we used the old chalkboard and eraser, which I've done for many years and got white lung from all that chalk. But yeah. Dividing income, the division of 150,000 of net income will be reported on the bottom of the partnership income statement as follows. Annual salary allowance, 50,000, 60 to Stone, and 48 to Mills. And the remaining income is split equal. So you had net income 150. And they're doing the same as I did, 60 and 48, 108, 21, 21, 42. This adds up horizontal and vertical. Now, journal entry. We made that much income. We debit income summary for 150,000. We credit Stone Capital for 81,000, and we credit Miles Capital Deals for 69,000. That would be the journal entry to put their income on the books. They make two closing entries at the accounting period. The first closing entry closes all revenue and expenses. Now here they may close directly. The second closing entry closes each partner. Remember we did away with income summary? And this is easier. We debit revenue, credit expenses, and there'll be a list of expenses. Jennifer Stone Capital, Miles Capital, that does away with the income summary. Now, the same thing happens here with LLC, except you credit members' equity instead of capital. So I like this closing entry better. It's one instead of two or three. The second closing entry, assume that Stone and Miles, they withdrew money. Then you debit their capital account and you credit their drawing, just like we did in a proprietorship. LLC, you debit their members' equity and credit their drawing. Remember, they're not giving themselves a paycheck. A partnership agreement may divide income based upon interest on capital. One such method of dividing partnership income will be as follows. Salary allowance, interest on capital remained unequal. All right, let's practice an example for you 18 that are here today. All right. I've already gotten 2 or 3 texts of people who are live streaming, and I don't blame them today. This is where live streaming comes in handy. All right, we're going to have just A and B partner. All right, now A is going to invest 20,000. B is going to invest 30,000. I got to use what room I have here. And we'll agree to pay them 6% interest and the remaining equal. And we're going to give A a salary of 5,000 and B a salary of 10,000. All right, now make yourself a heading, A and B. First off, partners' salary allowances. So let me get a notepad up here. A and B salary allowances 5 and 10. All right, now that's their salary. Now I want to give them interest of 6%. How much did A invest? All right, how much did I say A invested? What's 6% of 20,000? For a year, it'd be what? And then 6% of how much would B invest? 30? That 1,800? Six percent of we add those together, that's 3,000. All right, now what if the net income was equal to 60,000. All right. Now, what is 15 plus 3? 18. Now, 18 from 60 is what? That adds up to 60. All right, how did I say we were going to split the difference? Come in, gentlemen. Equal, correct? So what's half of 42,000? All right, so how much is A's capital? $21 plus 5 is 26, 27, 2. Well, what's that all about? I guess they didn't want to stay. I don't know. Anyway, this is 31 of 21, 31, 32, 8. All right, and what does 32, 8 and 27, 2 add up to be? All right. Now there's your format, horizontal and vertical. Now you're going to practice one totally on your own. All right. We'll have partner X and Y. Their investment is, that's investment, 40,000. 60,000. Their salary allowance is 15 and 25 per year. Interest on their investment is 10%, and the remainder equal. And the company made 120,000 net income. Now, take those figures and tell me how much X get and how much Y gets. I guess they're gone. Those two guys, I don't know them very well because they didn't take principles one. You folks at home live streaming, please practice this. Okay, are we ready to work it? Have you got it yet, Cole? Haley, you got it yet? I believe X is 44,000 just looking at it. And Y would be 66.
scroll up just a bit, honey.
What?
Scroll up just
All right, let's go ahead and look at it. All right, X and Y. How much salary did we give X? 15. And Y? That's a total already of 40. Interest, 10% of how much? Is 4. And 10% of 60,000? That's 10. And I said the remainder equally. All right. Now, isn't that pretty easy, folks? This would be 44. This would be 66. All right, any question now? Questions, Haley?
Isn't the investment 120,000? So how's that 100,000?
What now?
Is the, you told us investment was 120, net income?
Oh, that's 120?
Yeah.
That's why.
Well, then that's my bad. Up to 120, then this would be how much? What would that be? 70? 35? And 35. Now that's 120. And this is what, 54? And this is 76, is that right? That make it better? Okay, you at home, make those changes, please. All right, that was for 120,000, right? But now what if the net income was 40,000? Now what if the net income was 45,000? I want you to follow this. If the net income is 45,000, you do everything the same. Now remember, this has got to add up to be 45,000. However, this is already 50. If we give them a salary of 40 and interest of 10, then it takes a -5 to make this balance. So that's going to be a -2,500 plus a -2,500. It's got to equal 45. This is 19 minus 2,500, which would make that 1,650 or 1,750. That's 1,650 plus 2 would be 17. Yeah, that's correct. All right. And 25, 31 minus 21.5, or 25. That'd be 28, 5. All right, it has to add up to be 45,000. So here we illustrated a loss, not a loss now. They had a profit of 45,000, but we have to allocate salary 40. we have to allocate interest 10. And we gotta split the remainder difference, which is a -5. Okay? Back to PowerPoint. Okay. Assume that the proprietorship agreement for Stone, all right. Salary allowances 5 and 4. Interest of 12%. Capital for Jennifer and capital for Miles. Now you see, you gotta give them 5 and 4, and you gotta give them 12% and 12%, and the remainder equally. All right? Now they set it up, I hope the same way I did. Net income was 150. Give them salary, give them interest, give them the remainder equally, and that's 66.6. And what is that? 83.4. That's how it should be set up, folks. Now this remainder, how we've been splitting this remainder all the time, how we've been splitting the remainder equal. Well, we don't have to. We can split the remainder 2 to 3. We can split the remainder according to their salary, according to their investment. We can split the remainder in any kind of ratio we want to. Here is your closing entry, credit their capital, credit expenses, and debit revenue. And makes one simple, nice little closing entry. I just went over this example. Allowances exceed net income. You should see the minuses in there like I illustrated. Similar to what I illustrated. Again, your closing entries. All right, work that one. Take a minute and work that one. You at home, do the same, please. Come on, you ought to get it this time. Looks like Bernard didn't get a salary.
Let's get coffee downstairs.
Who made coffee? Oh, making that coffee pot.
I cleaned that coffee pot out, that coffee pot was filled.
Oh, but that been run. I used to run it. I used to make coffee.
And there's much coffee still left. You got fall people's actual house. Now this is.
I think I'm on that mine's house. Oh, it's got something with,
This is in this. Oh.
all right.
I think I just went through there.
Three out.
That's.
That's 1.6. Oh, I got more than exercise.
I'm trying to get you some extra credit there.
There you are, aren't they? These two up front here, I know Cole's in the county major over there. Jonathan, I think you're a county major.
Yeah, the county majors, they're the ones that show up most.
So,
Looks to me like you got another one back there that's pretty studious too.
Really?
Yeah.
He doesn't like to talk to about me.
She's
Put on a good show anyway.
she's Dr. Burko's favorite student.
No, I'm not.
Put on a good show anyway.
You know what Dr. Burko got on to for last semester? What were you wearing? Were you wearing house shoes to class?
No, I was wearing Nike sandals, and I came into his class and he told me I wasn't allowed to wear my bathroom shoes in his office.
What?
She wasn't allowed to wear her bathroom shoes to his
And I
office.
was wearing Nike sandals, but I let him know that I am allowed to wear whatever I want because I paid for it. So that it goes with me.
But you're finished, right? You're-
With him,
Yeah.
yes, for sure. For sure.
Times they have changed though, Paris. I remember when I went to college, I had a professor that would not allow you to wear a hat in the classroom. And they had one boy, he was bound and determined to show him one time. And I thought we was going to have a fight right there. And that boy took it off though before he got back there. He said, "I told you to take that off." Like that. He started back there for him. I thought, oh my God, we're going to have a tussle right here in the middle of the classroom. That boy got that hat off there, honey. 'Cause he knew he meant
Patsy
business.
Haggins would not let her students shoot gun in the classroom.
Yeah, well, that, for secretaries, that's, and for professional people, really, that's a must,
Yeah.
you know.
Now Cole's got a hat on, don't bother me a bit.
No, I don't care about that. I just don't want them wearing lingerie to class, men or women, okay?
They
And
want-
what I mean is outside, you wear the lingerie under your clothes if you want, that's your business. But you wear it on the outside, that's my business.
I don't care what they wear.
Let me tell you something, Paris, you've not seen a whole lot though. You've lived a sheltered existence. I taught up Northern Virginia for 10 years. And after you've seen what I've seen, there's certain things that you will not allow. Okay, I'm just telling you.
So what did you not allow up there, Phil?
Well, pajamas that come down to where you could see pubic hair, that's what I didn't allow, okay? Yeah. And it's a shame you gotta tell people stuff like that, but I wouldn't allow stuff.
Well, you already grossed us out.
Well, you asked and I told you. If you want to know the answer to a question, you ask and I'll give it to you.
Okay, now we got that straight. Has anybody got an answer on this problem yet? Oh, Philip. Now,
What does he do?
Philip was one of my accounting students at the community college. I told you all before. He was older. He'd worked for the health department. He worked up here in West Virginia somewhere, health department. And so he decided to go on and get his best degree and master's. And he's got his doctorate all but dissertation. He's an ordained minister. I don't know what else he is. He's an enrolled agent with IRS. But anyhow, I taught with him at the community college and was lucky enough to get him up here, and he is a hard worker and he will help students. And, you know, I can't even see him. The example he gave there, I just can't see anybody wearing clothes like that to class. Okay, I'll take Haley's bathroom shoes any day. Okay, no. Jonathan, have you got an answer yet?
Yeah.
What have you got for Prince, Steve?
135,150.
All right. Now, let's see what we got. Gosh, that's small. All right, you gave salary to Prince, Bernard 0, that's 42. You gave them interest of 9% on 20 and 150, 18, and 13.5. And then the remainder you split equally, which was 91,350 apiece. And that did give Prince 135,150 and Bernard 104,850. All right, now, folks, you've got a lot of practice on splitting income this morning. We got to leave it. We got to admit a partner. Why do you want to admit a partner? Does anybody remember? Why do you want to admit a partner? You need his intelligence. Why would you want to take Michael Jordan in as a partner on a tennis shoe store? Just his name, right? Just his name. So we take a partner in for different things. Now, the best way for a partner to do is just by pay into it. All right, when a new partner is made by person interest, that's easy. You may contribute assets, that's easy. All right. Now look at this. Assume that on June the 1st, Tom and Nathan each sell 1/5 of their partnership equity. Bring it consulted to Joe for $10,000 in cash. Now on June the 1st, the partnership had total assets of 120 and total liabilities of 20, or net assets of 80. No, wait a minute. Net assets of 100,000. Both existing partners then have capital balance of 50,000 each. All right. Now, he's going to get how much of their interest? How much does he want to get of their interest? Look right here. 1/5. What's 1/5 of 50,000? Huh? 10. Haley, read this chapter well and do the even exercises all you can.
Okay,
Okay.
thank you.
All right. Now that works out good. 1/5 is 5,000 and 1/5 is 5,000. So you debit their capital 5,000 apiece and you credit the new man's capital. Now, it wouldn't have mattered. Here's the entry. You debit their capital. Wait a minute. Okay, let's see. 1/5 of their capital was 10,000, wasn't it? Okay, and he gets 20,000. But here's what I wanted to show you. For 10,000 in cash. Now he's only paying 10,000 cash. So each partner gets how much? Each partner gets 5, don't they? That's separate entry. It wouldn't matter if he gave them $1 a piece. This would be the same entry. If he gave them $1 a piece or a bag of peanuts for their interest. That is their own journal entry. But the business journal entry is the ownership. Andrews and Bell minus 10 apiece and Cantor a plus 20. Okay? That's omitting a partner. Now we might want to omit a partner because we need the cash. And here's your posting. Total equity is still 100,000. They're telling you what I told you, the entry would be the same. I assume that instead of purchasing 1/5, all right, Tom and Nathan, Joe Cantor contributed 20,000 cash to bring a consultant for ownership equity of 20,000. All right, here, if you just want to let him in and give you the business 20,000, then there'll be 120,000 total capital. Then the partnership debits cash, credits his capital. The assets are 120. Now, you might have to reevaluate the old partnership You may have to adjust the partnership accounts. Assume they have 50,000 capital accounts. The balance of the merchandise account is 14, but the market value is 17. And what you'll do here, you'll debit merchandise inventory of 3, and if they're splitting capital 50-50 or gains and losses, 1,500 apiece. Now that's if inventory is more valuable than what it is on the books. It could go the other way also. You could reverse this entry if it was a loss. You don't put accumulated depreciation on the books. You got a new business here, and assume that Tom and Nathan have capital balances of 50. That equipment 15,000, accumulated depreciation 4. That means its book value is 11. It was revalued down to 10. There's a $1,000 loss then. So you debit accumulated depreciation to get rid of it. They split that $1,000 loss, and you credit equipment for the 5,000. So you have no accumulated depreciation. Now we're going to admit Nelson here. He's going to donate land. He invested 45,000 for equity of 45. Prior to investment, land was revalued to market value of 260 from a book value of 200. Lynn Lawrence and Terry business for cash. So that's the different ways to omit a partner. Well, you might give a partner a bonus. Why would you want to give, if a partner only wanted to give you $10,000, why would you give him $15,000 as a partnership? You need the money. You need his ability. Or the new partner may put in more money. All right. Assume the partnership of Marcia and Jenkins and Helen is considering a new partner, Alex. After the assets of the partnership have been adjusted to current market values, the capital balance of Jenkins and Kramer are as follows. Okay, this is Jenkins, this is Kramer. They're considering Alex. Now they have 20 and 24, total of 44. Now, how much money is Alex Diaz going to put into the business? 31,000. That gives you a total 75,000. But you're going to give him a third, which is 25. He's putting in 31. So what happens to the other 6? That's a bonus to the old partners. So cash of 31, 25 to the new partner, and the other 2 partners split that 6. Now that's a bonus to the existing partner. You can give a bonus to the new partner the same way. Equity is 120. He's going to put in 30. He gets 1/4 for 150. He's only putting in 30, but he's getting 37.5. Then that 7,500 has to come out of the old partner's capital, debit their capital 5 and 25. Okay, so that's omitting a partner. The old partner's getting a bonus, the new partner's getting a bonus. Now, here goes a partner. So this chapter has 4 main topics. 1 is to split income equally or however. 2 is to omit a partner. 3 is a withdrawal of a partner. And 4 is a liquidation. That's what this chapter has. And we've looked at 2 parts this morning, and we're going to let a partner go here. All right, a partner dies, then the proprietorship accounts are closed. And then you work it out to start over, whatever. Let's look at some example. It's liquidation. All right, now I want you to look at this partnership. We'll get out here in about 10 or 15 minutes. All right, you've got this much cash and non-cash assets. This is equipment, merchandise, inventory. And you've got liabilities and capital. Now, this partnership wants to go out of business. You've got to give everything a zero balance when liquidating. Okay, Farley, Green, and Hall share income and losses in a ratio of 5-3-2. That is 5/10, 3/10, 2/10, or 50, 30, 20%. All non-cash assets are sold in a single transaction for $72,000. Now, what are those? What are they on the books for? What is your non-cash assets on the books for? How much is that, Cole?
60.
All right, 64. But you're going to sell them for 72. How much of a gain is that? All right, now we're going to split that gain of 8,000. Okay. All right. Now, how do we split that gain? 50, 30, 20. Farley, Green, and Hall splits that 4,000, 24, 16. All right. Now, this is how they should set that up. This is the way I want you to set it up in a homework problem. All right, you put the balance sheet at the top. That's a balance sheet. Assets equal liabilities plus capital. You sell the assets, you got 8,000 gain. Now you add everything again. You pay your liabilities. And now you should have enough cash to pay each partner what is on the books. But now if you sell those non-cash assets at a loss, or no, there's 3 cars on it. That's the least I've ever seen in that park. Oh, well. All right, so you will have to do an owner's equity. You got to make journal entries for all of these things. You got to debit the cash and sell the non-cash assets, credit a gain here, or you could credit each capital account, because if you got to turn around, debit a gain, and credit each capital account. Here's the entry for closing out. You pay your liabilities and credit cash. Now you're going to pay all the partners and credit cash. Now, when you post, you've got zero balances everywhere. And then they give you another example here. And this is what I want you to practice. Now, folks, that is pretty much the chapter, unless, let's see, one other example here, right here. Okay. How much did we sell our assets for? 10. We had a loss of how much? And we split that 50, 30, 20. Now, what happened to Farley over here after you split that loss? He has a 5,000 what?
Yeah.
Now, if this partnership is going out of business and you were Farley, would you give that 5,000 to the partnership that you've already lost? You've already lost 27,000. I mean, you've already lost 22, your capital. Are you going to give the partnership 5,000? If you did, it would be nice. All right, and he did. So now we've got enough cash to pay Green and Hall. But what if he don't? If he don't, then you got to split his 5,000 between Green and Hall. You cover up Farley's percent. What percent does that leave? 30, 20? That's a 2-to-1, 3-to-2. So that's 3/5 and 2/5. So 3/5 of 5,000 would be 3,000? All right, so they would have to soak up his losses. I don't know if they showed you that or not. That's what would have to happen. Okay. Now, that's just going through the book. And we got a few problems in 11 to back up and do. I hope you read this chapter on partnerships. Now, I told Haley to be working some even problem exercises. So let me point those out. 2, 2, 4, 6. 2, 4, 6, 8, 10. 2, 4, 6, 8, 10. Let's see. 12, 14. All right, that's 2, 4, 6, 8, 10, 12, 14. That's your exercise on chapter 4 that you should do between now and Thursday. We'll review all these concepts again, okay? Cole, I appreciate you and Jonathan making it today. And takes a special effort sometimes. And you other folks that didn't make it, I probably don't blame you. But I hope you live stream, and I hope you write me a summary of what you may have seen today or what we did. Okay, hope to see everybody on Thursday. So I'm stop broadcasting.